things get a little bit different now starting in Chapter 4. Why? Well, we'll show you in the next few minutes when we introduce to you the accounting activities for a merchandising business. So far, we've done all of our examples with service businesses, like maybe consulting firms, law firms, marketing firms, or so on. But everything in chapters 1 through 3 that we've done dealt with doing the accounting for service businesses. Now in chapters 4 and 5, we focus more on merchandising businesses, like Target, Macy's, and Walmart, where you walk into a store, you buy things and stuff, and you walk on out. And those type of businesses, Target, Macy's, and Walmart, sell merchandise. So just a quick overview. You probably know this already from even a high school accounting class. But you've got manufacturers over here that make goods. And then oftentimes, they will sell those goods to a wholesaler, which will buy them in huge, big bulk quantities from manufacturers. Now, just a heads up, we do more of the accounting for manufacturers later on in this course. Then, after the wholesaler buys these in huge, large quantities, oftentimes they resell them to your local retailer, like the stores that you and I walk into every single day. So just a little bit of background between how goods get from the manufacturer all the way to the retailer that we visit from time to time. So this is what you learned in our first couple chapters when we try to figure out net income. Look in the upper right-hand corner right here. There's your net income. And it was pretty darn simple. We just took our revenues minus our expenses, and there we go. That was our profit or our loss for a period of time. Now let's show you how we calculate net income for merchandising companies. Notice this first phrase here. This is a term you're going to get used to in the next couple of chapters called net sales. That's the term that we typically use for when we sell merchandise, is our net sales. Then we subtract out something called cost of goods sold. I'll give you more detail on that coming up in a moment. But we take our net sales, we subtract out our cost of goods sold, and that gets us to what we call our gross profit. So for example, here's my coffee cup right here. Go Brewers. And let's say I sold you this coffee cup for $15, but I paid $10 for it. I would have a $5 gross profit. My sales of $15 minus the cost of buying this Brewers coffee cup gets me my $5 gross profit. Then I subtract out any other expenses, and that gets me to my net income. So you've got this little piece right here, cost of goods sold, we never worried about with service businesses. Or going back to our very first video lesson that you watched for this class at the beginning of chapter 1, there was my daughter at I think 3 or 4 years old selling lemonade. And let's say she sold $50 worth of lemonade in one day. But then we have to subtract out the cost of making the lemonade, like the ingredients, like the sugar and the lemons and the cups and everything else related to making lemonade. So then our gross profit would be $30. Sales minus the cost of making a cup of lemonade equals her gross profit. And then let's say she hires the girl down the street, her friend, to help her out and pays her $5 for like wages. Then we get to the final net income number of $25. Get used to this formula, people, because you're going to see this time and time again over the next several chapters on how we figure out net income for a merchandiser. So on the left-hand side is the income statement for a service business like H&R Block that does taxes. Again, very simple. Revenues minus expenses equals net income. A merchandising business goes along with the diagram we showed you on the last slide. We take our net sales, subtract out the cost of the merchandise we sold, gets us our gross profit. Then we subtract out all of our other expenses like advertising and rent and salaries and wages and everything else, which gets us to our bottom line, net income. Again, get used to this format going forward in this class for merchandisers. So cost of goods sold, I alluded to it in the previous slide, but it's the cost of the merchandise we just purchased. So again, if we sell something if I sell my Brewer's cup for $15 and I paid $10 from my wholesaler or $10 from whoever I bought it from, my 15 minus 10, I would have a $5 gross profit. And that's our gross profit. It's whatever's left over after we take our sales minus our cost of goods sold. This is a big number. Oh my gosh, this is a huge number that merchandisers analyze in the real world. And we talk more about analyzing gross profit later in this class. And then we have our operating expenses, our typical normal expenses that we pay to get to our final net income number. So merchandise inventory, that's an account that you're going to get used to now that you've never seen before in our previous lessons because they are service businesses. But merchandise inventory is the merchandise a business sells to customers. It's not supplies, it's not equipment, but merchandise inventory is what we plan to sell to our customers. It includes the cost of buying these. It includes the cost of any shipping we paid to get it to our business, and it includes any cost ready to make them ready for sale for our customers. Now, over here on the left, when we did the balance sheet for a service business, and we looked at the current assets, remember those are the assets that turn into cash or we use up within a year's time, we never had merchandise inventory because we had a service business. But now take a look at this. Because we typically list assets, current assets, in order of liquidity, how fast we can turn them into cash. Cash is always first. In real life, short-term investments would go second. You don't see it in this example, but typically short-term investments for a business goes next. Receivables third, because you collect receivables within a month or 2 or 3. But typically you'll find merchandise inventory right below receivables, because oftentimes it might take you like maybe a couple months to sell that item off your shelf. And then you get your other prepaids, like supplies and rent. But merchandise inventory is the brand new account you're going to be working with a lot in these next 2 chapters, and it's a current asset typically located below receivables in the order of liquidity. This is what's called the operating cycle of a merchandiser. I don't want to spend a ton of time on this, but we start with cash. They have cash on hand, and they go out and they purchase merchandise. Looks like we're selling bicycles in this example. Okay, we bought some bicycles, they're in our store, and then most business-to-business transactions are on credit. Now, I know when you walk into like Target or Walmart or the Dollar Tree or the grocery store, you pay in cash or your debit card, usually. But most business-to-business transactions are sold on credit, which means now you've got to keep track of your accounts receivable. Who owes you money, and are they past due or not? And then finally, after you give them, let's say, 30 days to pay you back on the receivables, then you collect the cash from your customers. So this is what's called the operating cycle of a merchandiser. Now, companies use 2 different types of inventory systems. Well, let me backtrack. They could use one or another type of inventory system to keep track of their inventory and try to figure out the dollar amount they are going to put on their balance sheet for merchandise inventory. One, my friends, yeah, it looks like we sold some. So there we go. Let's go backtrack a little bit. So here's your inventory. You sold 2 items, and now your ending inventory is 4 items, and the dollar amount you decide to put on your balance sheet based on those 4 items left in your ending inventory. All right, my friends, we got 2 types of inventory systems, a periodic inventory system and a perpetual inventory system. Now, a periodic inventory system just means periodically, every once in a while, usually at the end of a year, maybe sometimes at the end of the month, but usually at the end of the year, we will actually do a physical count to determine our inventory. So give me 1 second here. Let's count. 1, 2, 3, 4, 5, 6. Typically, maybe once a year, or maybe once every 6 months, you count your inventory to determine how much merchandise inventory you should put on your balance sheet. And that cost of goods sold you should put on your income statement. Now, I'm not going to lie to you that this method is becoming much less popular. In fact, we're not really going to focus on this periodic inventory system in this textbook because those are typically for companies that don't have like barcode scanners. And nowadays, with technology, these information systems is pretty easy to come by as far as, even for small businesses, being able to use barcode scanners and keep track of their inventory through those barcodes. But in a periodic inventory system, for those companies that still use it or small businesses, you only update merchandise inventory at the end of the period, and you only record cost of goods sold at the end of the period. That's a periodic system. A perpetual system is what we're going to focus on in this class and what most businesses use nowadays. A perpetual system keeps a running computerized inventory merchandise record because we're using those barcode scanners. So the next time you shop at Walmart and you pay for something at the self-checkout and you use the barcode scanner, it's the computer systems automatically updating the inventory going out the door and the cost of that inventory going out the door. So we have it keeps on perpetually changing. For every purchase a merchandiser makes and every sale a merchandiser makes, the computer system updates inventory. We record cost of goods sold after every single transaction, and you're going to see that come up later in this chapter on recording cost of goods sold after every sale that we make. And it gives us a better control of inventory. Our computers are going to give us a really good estimate as far as how much inventory we actually have on hand at any particular point in time. So this is the more dominant inventory system nowadays, is the perpetual inventory system. So the way the inventory flows throughout a merchandiser, get used to this formula right here. So when you walk in the door, let's say on January 1st, the beginning of the year, you're going to have some type of beginning inventory. Then throughout the period, let's say just a month for this example. Let's just go a month period. You buy more merchandise throughout the month. If you take what you started with plus what you purchased, that would be your merchandise available for sale throughout the month, let's say. And then at the end of the month, you determine what inventory you still have and what inventory you sold. If you sold it, that number goes on the income statement. If you still have it, that goes in current assets on the balance sheet. So let's give you a quick example here. Let's go back to my daughter again. Here we go. But let's say she's not selling lemonade. Let's say in this example that she's selling containers of slime. Now, I don't know about you, but when I was young, slime was not a big deal. With this age group, slime is a huge deal. So we have much more slime in our house than what we need. But anyway, let's say that she's selling containers of slime. Let's say it cost Addie $1 to purchase these containers of slime from her supplier. So let's say she starts the month with, or let's go with the month. Let's say she starts the month with 1 container of slime. She goes out to her supplier, maybe Amazon, and let's say she buys another 1, 2, 3, 4 containers of slime. So if we take what she started with, because each of them cost $1, plus what she purchased throughout the month, she must have had 5 containers of slime available for sale. Now it's the end of the month. She counts up how many containers of slime she still has, and it looks like she still has 2, which means if she had 5 available and she still has 2, she must have sold 3 containers of slime that cost her $1 each for a total of $3. This is the flow of inventory for a merchandiser. The inventory you started with, plus your purchases, gets what you have available for sale, and then at the end of the period, you either still have it or you sold it. Now watch this. Watch this $3 of cost of goods sold over here. We can take that and plunk it into our income statement. So if we're assuming that Addie sells these containers of slime for $3 each, we've got 1, 2, 3 times $3 each. Her sales must have been $9. Her cost of goods sold, the cost of the containers of slime, was $3. So her gross profit was $6. And then let's say she, again, pays a friend $1 for helping her out. That gets us her final net income number. Now pay attention to this slide right here, because in your first practice set in Chapter 4, you've got a practice activity that lumps these two things together, and students in the past sometimes have found it a little bit tricky, so maybe this slide will be helpful to you when you go through that practice set at the beginning of Chapter 4. Well, welcome to Chapter 4, the beginning of doing accounting for a merchandiser, and let's have you start doing some practice.